Uh, Good evening, everyone. So, welcome to my YouTube channel, Tirumala Reddy. In this video, I'll be discussing one important concept from cost and management accounting. That too from an important chapter, standard costing. Okay. Basically, when we discuss about a chapter called standard costing, so it is nothing but I am comparing my actual figures with my standards or budgeted figures. Just understand for the time being, we may use the word budgeted and standard synonymously, but there is a minor difference. Okay, there is a difference, but for the time being, assume both are same. So I will be taking my budgeted, and then at the end of there, I'll go with actuals, and then take the difference. That I call it as variance. Okay, so basically in this chapter, I will be discussing about how much variance I got for a particular parameter. So basically, when I do the business, I'll estimate my cost, I'll estimate my sales, I'll estimate my profit. So whatever profit I estimated, that profit in reality I did not get. Maybe I got more or I got less, as the case may be. So when you're getting more also there is variance. When you're getting less than the expected profit also there is some variance. So here I'm not talking about the extra or shortfall. We're basically talking, is my expectation reaching my actuals? Is both same or is there any difference? If there is difference, that I'm calling it as variance. Now tell me, if there's a difference in profit, that difference can come through cost or it can come through income also. Income also. Now, if the reason is income, that we are calling it as sales variances. If it is coming from cost, if the difference is coming from cost, that I am calling it as cost variances, and these costs can be either material cost, we call it as material variances, or there can be labor cost, labor variances, or overhead cost, that to variable overhead variances, and then fixed overhead variances. So basically, to complete this entire chapter, I need to discuss about material variances, labor variances, variable overhead variances, fixed overhead variances, and then sales variances. Basically, when we see the CA curriculum, so he excluded the concept of sales variances, but for CMA we are having sales variances also. Now in this video, we will be discussing about some important variants where students may face it is difficult to understand. So in this video, I am just trying to help the students to crack the problem. So any problem given from the part of fixed overhead variances, how to solve the problem. Okay, so I'm not going to give entire concept, entire background, everything. Just from exam point of view, how to solve a problem. Okay, now before we talk how to solve a fixed overhead variance problem, let us understand how a problem can be given. Basically, two types of problems can be given. If category 1 is given, we are required to calculate 5 variances. If a category 2 is given, we are required to calculate 6 variances. You'll understand the difference in question first. So what are the two different types of questions that can be asked? Okay, so I'm taking example from CA material, CA intercom material. Now, if you see this question, he has given us some information. The cost of J and J Limited for the month of September is as follows. He has given me budget figures. He has given me actual figures. Nowhere he talked about a number of days. So basically, what happens? At the beginning, I may plan for working 30 days, but in reality, I may work for 28 days. Okay, so if that information is also given, the number of days worked or the number of days the production is done. So I'm expecting for 30 days. So budgeted number of days, actual number of days, that is also given, and there is also variance in that. Like I plan to work for 25 days, I actually worked for 28 days, or I plan to work for 30 days and I actually worked for 28 days. There's a difference, no? If this type of difference is there, along with normal variances, there will be one extra variance called as calendar variance. Okay, that we'll discuss. Okay, so when I'm talking about different types of problems from fixed overhead, my intention is the number of days worked, that concept. Okay, I'm planning to work so and so number of days. Actually, I worked for so and so number of days. That point is not touched in the question. That is category 1 problem. If that is also given, that is category 2 problem. In case of category 1 problem, we are having 5 variances. You need to do calculation of 5 variances. In case of category 2 problem, 6 variances. That extra variance is calendar variance along with 5 variances that we are gonna do in case of category 1 problem. Okay. So now first we'll talk about category 1 problem. Once you are comfortable with that, we'll move on to category 2. Okay. And then don't ask entire concept here. So I'm trying to make it as easy as possible so that you can do this particular problem in the exam. Okay. So if you want complete conceptual clarity regarding what is what karke, okay, you can subscribe to my entire course on this cost and management accounting that is completely available, almost lasting for 140 hours. So here I'm just trying to help you how to solve the problem in the examination. That's it. Okay. Now, let me tell you something, Nana. So basically, here I will be using 3 types of data. One is budgeted data, actual data, and then standard data. Standard data. So might be you're comfortable with actuals. Okay. So everyone have a great idea on that. Appreciable. Now when I'm talking about budgeted and standard, so many of us are not having clarity. So what is budgeted and what is standard? Okay. So we assume both are same, but there is a minor difference, Nana. Okay. Let me tell you that difference first. With a small example. Now what happened? Ki, when I'm doing budgeting, I am expecting that I am planning to produce 10,000 units. Manlo, I am trying to produce 10,000 units. So I'm expecting to produce 10,000. So after completion of the year, in reality, I produced only 8,000 hours. 8,000 units. And to produce 1 unit, I require 2 hours. Okay, my standard hours per 1 unit is 2 hours, and I am expected to produce 10,000. This is estimation, not reality, not actuals. And this is actuals. Now, from this, my budgeted hours would be how many hours I am planning per unit. Standard hours 2 into what is my budgeted output 10,000. So 2 multiplied by 10,000 will be equal to 20,000. These are called as budgeted hours and they are not called as standard hours. When I am talking about standard hours, this 10,000 should be replaced by 8,000. So in general, I will calculate my total budgeted hours based on budgeted output, and I will calculate my standard hours based on actual output. So that's a basic difference, Nana. In both the cases, I'll be going with the standard hours only. Hours are standard only. If I am going with the budgeted number of units, they are called as budgeted hours. And if I am going with actual units, that is called as standard hours. Okay. Now, so to solve a problem from fixed overheads, I am preparing a 3x3 matrix. Okay, to just dump the data what is given the question here. So what is the data exactly? The first one I'll go with the budgeted hours here. Budgeted hours. Here I will go with actual hours. Here I will write standard hours. Okay. So it can be per unit or it can be in total depending upon question to question. So what are my budgeted hours? I think now we are comfortable with what is budgeted hours and what is standard hours. Then how to calculate actual hours? Simple. Here what you are doing? This is my expected duration per unit. In reality, I may take only 1.9 hours per unit. So this 1.9 multiply with the actual output. Those are called as actual hours. So everything running between these 3 or 4 numbers only. If I am multiplying my actual hours or actual output with the actual time per unit, those are called as actual hours. My standard time per unit with the budgeted or standard output, budgeted hours. I am multiplying my standard hours per unit with the actual output. Those are called as standard hours. So I'm starting with budget hours, actual hours, and the standard hours. Here I will go with okay, total budgeted overheads. What are my total budgeted overheads? Here I will go with the total actual overheads. Here I will go with the recovered overheads. And if you remember, you would have discussed in a chapter called overheads or in a chapter called ABC costing. So whatever I am having those indirect expenditure known as overheads, that I need to apportion to different products or services as the case may be. So for apportioning to those products or to those services, I have to calculate something called as overhead rate or ABC rate. So that rate I am calling it as recovery rate, and then using that recovery rate I will apportion the overheads. No, that is called as recovered overheads. Now to calculate this recovered overheads, I need something called as a recovery rate. So take that recovery rate here and here. Hope this matrix is clear to everyone. Okay, once you are comfortable with this matrix and what data to dump here, problem is done. Pakka, very easy. Now see what I am calculating: budget hours, actual hours, and then standard hours. Budget overheads, actual overheads, recovered overheads, and I am taking my recovery rate here. Okay, so how to dump the data here? We have seen a question previously. I'll take that question and then I'll try to dump the data here. Okay, chalo. Is there a question, everyone? So what is saying? The cost details of J and G Limited for the month of September is as follows: fixed overhead, budgeted, total, my total budgeted overheads, total actual overheads. One is 15 lakhs, other one is 15 lakh 60,000. So budgeted overheads, actual overheads. So we have to dump this data here. Budget overheads 15 lakhs, actual overheads 15 lakh 60,000. So here I will write 15 lakhs. Here I will write 15 lakh 60,000. Next, units of production, budgeted output 7,500, actual output 7,800. Standard time for one unit. Now understand, standard time is given, and then along with the standard time he has given me actual output as well as budgeted output. I told you initially, if I want to calculate my total budgeted hours, it should be standard time per unit multiply with the budgeted number of units. Standard time per unit multiply with actual output, standard hours. Okay, now with this 2 and with 7,500 into 2, 15,000 will give me budgeted hours. 2 into 7,800 actual output into standard rate will give me standard hours. So 78 into 2, 15,600. So 15,000 my budgeted hours, 15,600 my standard hours. Okay, so we'll write there. Here 15,000, how you got it? 7,500 into 2 actual hours. We'll fill in this blank. Standard hours 7,800 into 2, 15,600. Now let's continue with the question. And then actual hours worked has given me 16,000 hours. So that we take directly 16,000 hours. So what about the remaining things? We'll fill it out. So we have budget hours 15,000, budget overheads 15 lakhs, my total overheads 15 lakhs, total hours 15,000. And recovery rate means at what rate per hour I am recovering? It should be budgeted overheads divided by budgeted hours. So 15 lakhs upon 15,000 would be 100 rupees. 100 rupees. Now this is RR recovery rate. RR recovery rate, both should be same, no? So you also take 100. Now understand, Anna? Here you got a recovery rate as a budgeted overheads divided by budgeted hours. Okay. Now if you want budgeted overheads, I have to multiply these two, no? In the same way, here my recovery rate should be ROH upon standard hours. Now I want ROH, so do cross multiplication. Now you know RR 100, you know SH 15,600, multiply both, it should be 15,60,000. So that would be ROH. Hope this is clear. So once again, this same diagram I'm writing once again, Anna. It has become a little clumsy, you know. So I'll write below and then we'll continue. Okay. So same figures, nothing change. Okay. So this is budget hours, actual hours, standard hours, budgeted overheads, actual overheads, recovered overheads, RR, RR. That's it. Okay. So let's fill the everything. So 15,000, 16,000, 15,600, 10,000, 16,000, 15,600. We got RR as 100. Here also 100. And then BOH we got 15 lakhs, 1560, 1560. This is 15 lakhs. This is 1560. This is 15 lakh 60,000. Okay, once the entire data is done, problem is almost done. Now, is a category 1 problem. That means we are not having the difference between number of days wala concept. So how many variances? Only 5 variances. Sir, what are those variances? And the first one, fixed overhead, cost variance. Second one, it should be, remember this order. Okay. Second one, fixed overhead. Second one, fixed overhead, expenditure variance. Next one, fixed overhead, volume variance. Fourth one, fixed overhead. The next one, fixed overhead, efficiency variance. And last one, fixed overhead, capacity variance. So try to memorize this in the same order. Okay. Now see Nana here. See my directions of the arrows also, what I am putting here. This is my first arrow. Okay, in this way. Okay. This is my first answer. That means 15,600 minus 15,60,000 minus 15,60,000 will give me the first variance, that is cost variance. Second one, you take this way. Okay. So BOH minus AOH, that would be your second variance ka answer, that is expenditure variance. Next one, this one. Okay, this is third ka answer. ROH minus BOH, 15,60,000 minus 15 lakhs will give you third variance ka answer, that is volume variance. Okay. Next, this one here. So SH minus AH, but multiply this with RR. This will give me fourth variance ka answer, that is efficiency variance. So efficiency variance ka formula would be SH minus AH multiply with the RR. Next, AH minus BH again multiply with the RR, that gives you fifth variance ka answer. What is fifth variance? Capacity variance. Okay. So if you have this idea, no, everything is done. So now what is first one? 1560 minus 1560, answer is 0. Express second one, POH minus AOH, 15 lakhs minus 1560. So negative 60,000. So negative in the sense that should be adverse or unfavorable. Third one, SH minus ROH minus BOH, 1560 minus 15 lakhs, positive 60,000. It means favorable. Next, fourth variance, that is efficiency variance, SH minus AH multiply with the RR, 15,600 minus 16,000. So negative 400 into RR. So 40,000 negative, that means 40,000 adverse is favorable. Fifth one, AH minus BH multiply with RR, 16,000 minus 15,000, 1,000 into 100, 1 lakh positive, so again favorable. So this should be 1 lakh favorable. Okay. So if you are comfortable, Anna, once go through what I am doing, prepare this table. So ROH minus AOH would be first one ka answer. AOH minus BOH minus AOH, second ka answer. ROH minus BOH, third ka answer. And then SH minus AH multiply with RR, AH minus BH multiply with RR. Okay, we get all the 5 variants ka answer. The only thing is you need to recall this order. So cost variance, expenditure variance, volume variance, efficiency variance, capacity variance. Just to cross check, Nana, to give you confidence. So once go through these answers, go through these answers. Okay. Overhead variance 0, cost variance 0. We also got cost variance 0, right? Next one we got expenditure variance 60,000 adverse. Expenditure variance 60,000 adverse. Third one, volume variance 60,000 favorable. Volume variance 60,000 favorable. Next, efficiency variance 40,000 adverse. Efficiency variance 40,000 adverse. Capacity variance 1 lakh favorable. So capacity variance here also favorable. Very, very, very beautiful notes that I have prepared for you. Okay, so whatever problem comes from this category, you'll be able to do. Maybe in a day or so, you'll be getting one more video, category 2 wala. So just before exam, if you want some clarity regarding fixed overhead, go through these 2 videos and damn sure you'll be successful. Okay, and I again same thing. I won't ask you to subscribe to my channel or like my video. If you feel this man can make accounts or costing easy, only in that case you please spread this video to everyone and please subscribe to my channel, or else I said don't subscribe when it is not useful to you. Thank you, Nana. Thank you. Keep supporting. Bye bye. See you. Thank you.